Okay, good afternoon, folks. Today we're going to be talking about the capstone simulation, and so my name's Christopher Gluckler. I am going to be representing the Baldwin team, and we're going to discuss our round 6 debrief. So, alrighty, let's get started. Now, the purpose of this is going to investigate the firm's current state of affairs. We're going to review the strategy that we elected to go forward with and the implementation of that strategy. Now, I've split this into 3 parts. Part 1 is going to be a look at the strategy and an overview of kind of how we've done in recent rounds. Part 2 is going to be a detailed look at the balance scorecard, and Part 3 is going to be wrapping everything up with a conclusion and kind of maybe some suggestions on how we can fix things going forward or how we can improve upon our current standings. Now, the business strategy that we have elected to go with is the niche differentiator. We originally started with our broad differentiator, which kind of has products in every market. There's nothing really extremely special about the products. You're just trying to cut your cost and be efficient and whatnot. And you're going to have all 5 markets, at least one product in each one of those. And we originally wanted to do that. But what ended up happening was the cost of producing products for the traditional and low end, just the sheer volume of sales in those markets, and the cost, we would have to invest a lot of money in automation and various things to make those products more efficient, and it was just too much of a burden. So we elected to go with the niche differentiator because we were focusing on the high end and the size a little bit more so anyways. So that we elected to retire those products and get out of the traditional and the low-end market. Now, see, our overall goal is to gain a competitive advantage by distinguishing our products with unique designs that are easily accessible to the customers. Now, the firm will emphasize competent R&D intervals to stay ahead of the market. We want our products to lead in the size and performance offerings at an above average price level. So we want to be that top of the line producer in the sensor industry. Now, there are some basic keys to success with this strategy. Of course, convenience. We need our products to be easily accessible to the customers. Convenience is what drives our current market, so this is very important here. We need a high degree of awareness. We need to promote these products, get the name out there, and which we actually have done a fair good job of that, to be honest. And of course, our superior design strategy. We need to maintain fresh and new products, as they say. Keep new products always coming in. We're going to be retiring our old products, and what we'll do is we'll inform the unique designs through routinely developing in the high-end segment, and we will kind of phase out, if you will, the older products into the size and performance markets, and then just phase them out of existence beyond that. So kind of gonna, every few rounds continually develop a new product for the high end and take those that are in the high end and kind of phase them to the size performance segments. And that is the key to success there. Now, when we're taking an overview and a look at how Baldwin, what they've achieved and what Baldwin has done as a company, really the performance historically has been subpar. We've had plenty of issues with revenue, or lack thereof, really. We have cash flow problems. We are not getting the sales that we need. Since we are in the high-tech kind of segment, the high-tech industry, we have very high variable costs, and we're not really seeing a lot of sales come out of that. So this has been a continual issue. We dumped a lot of money in developing new products early on, and we have come out with 2 total products over the last couple rounds, and it hasn't bore any fruit. We haven't seen any kind of return in the sales department on these products, so it's very disappointing. It actually has been very hard to kind of climb out of this hole, to be honest. So for a while there, we were kind of just treading water, so to speak. And another problem we've had is just suboptimal market share for segments that we aspire to dominate. So the high-end market, I mean, we had at 1.3 products in that market, and we were maybe getting a total 20% market share in there. I think it was even lower at one point, a few rounds back, and a little bit on the embarrassing side, to be honest. So now, we also have kind of bet the farm. We have extended all of our stocks, we have borrowed all of our long-term debt, and pretty much leveraged the company up to the hilt. So this problem kind of is probably what's contributed to our kind of feeling like we're in molasses and our lack of success, because we're paying interest on all of this, and we're paying out dividends, or at least trying to, and these things, and like I said, we have had this capital that we raised this capital, and we have not achieved any kind of modicum of sales, really. So it's been a little bit frustrating, to be honest. Now, the good of what we've done, we have seen gradual improvement in the scores over the last few rounds. It's been consistent. I know on round 2 we had a slight dip, but then on the following rounds we have just consistently gone up. And actually from round 5 to round 6 we jumped 10 points on the scorecard, which is our biggest leap, up or down. That's our biggest movement, which is fantastic. Obviously, we want to keep on innovating and keep these improvements coming year over year, or round after round. And this is the first round, graded round anyways, that we have achieved a net profit, which is wonderful. So now, when we take a look at the scorecard here, on the far left we have the financial breakdown there. We have the stock price we got 0 points on. This has been a consistent issue for us. Our stock has pretty much been at $1 the last few rounds. It dropped pretty significantly after the first round or two as well. So I think we were at 20 after the first round or somewhere in there, and then it dropped below 10, and now we're at $1. This has been just an epidemic for us. Our earnings per share is just, it's not there. We need to earn more money. So we have, like I said, all of our shares are out on the market, but our earnings aren't bringing back in the numbers we need to increase this. So the 2 things we need to do to fix this: we need to definitely bring the sales up. We've got to bring the sales up. And the other thing that we can do is, once we do start to bring profits in and we get the cash flows coming in, we can choose to retire stock. That'll also, decrease the number of shares, because this is earnings over total shares here. So we'll increase our earnings per share, thus making our stock more attractive to prospective investors. Now, our profits, this is another area where we've had continual problems with. Now, at this round we have 6.63 million in profits, which, we will take that. It's not the greatest marks, but we will take it. It's better than none, or taking an emergency loan out, which we did do a few times. So we have seen some improvement here. We need more improvement for sure in this area. This is kind of, our company is hinging on this. If we don't start to bring in profits, we have nowhere to go, really. I mean, we have tweaked everything else and tried to fix things and improved in a lot of areas, but we never really saw any profits come in until this round. So hopefully that will continue. Hopefully we can grow those profits. Now, our leverage, this has been an issue. I'm kind of an anti-debt person. I don't like a lot of debt, but it's necessary in business to have some debt. We have pretty much extended all of our debt that possible, aside from taking short-term loans, which are at a higher percentage. Kind of want to stay away from those if you can. because they have to be paid back the following round. So, but our leverage score is at 18.3. We've got to decrease this. We want to be in like the 3-4 area, and then maybe even drop that a little lower. So we definitely need to fix that leverage score. Our subtotal there is 2.3 out of 25. So obviously this is a very poor spot in our scorecard. It just needs to be fixed. We need to increase these scores. This is definitely a bad spot there for us. Now, the second part of the scorecard is the internal process. Now, our contribution margin is at currently 30.7%. You can see there we've got a score of 2 out of 5. Now, we've kind of stayed in this area. We've been as low as about 26, and we've been as high as, I think, 30, 31. We kind of just fluctuate in that little boundary area. Now, in earlier rounds, that would have netted you a higher score, but as the rounds go on, the different ways that the numbers drift, you need to improve. So we have got to bring this up. We need to be more in the 40% region. Now, this is going to be difficult. Once again, we are in the high-end segment. This is a very costly segment to be in. So we need to continue to implement our TQM strategies to cut our costs, and we need to once we R&D a product and it's configured, maybe think about raising some automation to cut the labor costs down. This is a very difficult spot for us to achieve a perfect score, but some improvement is definitely needed. Now, our plant utilization, you see there we got a 5 out of 5. The target is 100 to 180% of production there of your capacity, and this we've had some problems in past rounds with this number. We now have improved that. We sold off some capacity because we had way too much at one point. Now we kind of got that sweet spot, so I think we probably will need to produce a little more. As you can see, we've had some stock out problems by the score there. I know 3 of our 5 products stocked out. BID, Buddy, and Bob all stocked out. So we definitely got to do a little better forecasting and increase our production. We may or may not want to increase capacity because you can kind of go into that second shift. But we definitely have to forecast better. Now, days of working capital, this area, we definitely need improvement. Now, once again, if you don't have money coming in, you don't have any way to kind of have your working capital in case your customers aren't paying you. Now, this is assets minus liability in terms of days, and you're supposed to have 30 days to get the max score, and above and below that in any kind of intervals you lose points. We don't have any days of working capital, so we've just, the profit issue has just definitely struck us, and we have not been able to fix that really at all, except for this round, like I said. So now the customer section of the scorecard, we've always, this is where we shine right here. This is definitely our bright spot on the scorecard. Our customer buying criteria, we get a 5 out of 5. Our customer awareness, we get a 5 out of 5. And speaking of which, we have 100% awareness on all 5 of our products. We have pretty much maintained that. We are at the maintenance level for all of those, at the $1,400 sales promotion, or the sales budget there, and totally just maintained that. So that's definitely great. Now, our customer accessibility, 4.1 out of 5. This is still outstanding. We have 100% in that section for BID, Balls, and Bob, and Bold and Buddy have both 70 and 75% respectively. So we can improve on that if we have the money to invest there. There could be some improvement. I wouldn't say it's number 1 on the list. There are other areas we need to improve in, but that's definitely good. Now, product count, we get 2.9 out of 5. That's because we only have 5 out of the total 8 products that they kind of want you to get full credit anyways. Now, our sales general and administration expenses, we got 5 out of 5. This is target supposed to be 7 to 17% of our sales. So we had 2,200 out of our total sales there. So actually, I don't even know. Now, the last part of the the balanced scorecard is the learning and growth segment. This includes your human resource module and your TQM module, which we have definitely been successful, and this has been another good section for us. Our employee turnover we've kept down to 6.1%. That's fairly low. We at one point were the best. A couple rounds ago, that's not the case anymore, but we're still doing very good. As long as we can keep those numbers low, as long as we can definitely, the target is 4%, so we're not far off. We didn't invest the full in on recruiting, but we do still have the full 80 hours for training, so there's room to improve there. Now, employee production, we've got 7 out of 7. We have, as you can see there, 118% of the employee productivity index there, and that is our target. So it's been very good. Now, TQM material reduction, we've reduced our material costs by 11.8%. The target there would be 7. So we're very successful in the TQM areas, as you can see. Now, our R&D reduction, we hit the 40.01%. The target was to be above 40. We just squeaked by, so we do get full credit there. The administration reduction there, we have 57%, and the target is at 60. So I've got to fix that number. We've only got 2.9 on that. And then the demand increase, we've achieved full there. So now, what we can do moving forward, we're going to need to maintain the firm's profitable position. We definitely want to keep the money coming in, keep the profits, grow those profits. One way to do that is we could possibly try and lower our variable costs in some kind of way to help better our contribution margin, and then also increase our profitability. So that'll kind of have a twofold effect, where we can kind of repair some of the lost points on the scorecard for the contribution margin. Now, we need to grow our market share, especially in the high end. We're definitely doing a lot better at this point than we were. Right now, BID in the performance market has 6.4%. That needs to improve. Bold is in the performance segment, that has 17.9%, which is pretty good, and Buddy is in the size market at 15.3%, and Balls and Bob are both high end, and they respectively have 14.7% and 11.5%. So we have definitely improved in our market share numbers, but when we talked about this strategy and really trying to dominate, we kind of expected maybe to have 2 products in the high end and really have 20% each there. That's some kind of better number than a total of 27.1%. So we're definitely better than we were a few rounds ago. When we were just starting to bring out new products and stuff, we had a lot of issues with our market share. And now that those products have come out, now that we've got the customers to recognize these products, we've seen success. So it's definitely been improvement, but there's still, we still got a ways to go. So, and I think in the end, if we just maintain our strategy, our implementation, we maintain our focus on the markets that we are trying to emphasize and dominate, we will find success. We need to just kind of figure out that variable cost thing and a few other tweaks in there, and we're going to be good. So I do want to thank you for your time today. I appreciate your attention, and I will see you later.